Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and I have Glenn Schultz with us today. Glenn is the head of agency mortgage prepayment modeling and strategy for MUFG. Today is Tuesday, September 7th, and thank you for joining us, Glenn. I hope you had a nice long weekend.
Yeah, I did. I hope you had one too. It's nice to speak with you again.
Thank you. So today, let's talk about, since August remittance data is due after the close today. So rather than discussing the upcoming prepayment data, I thought we could discuss the housing market, specifically home prices, and get your point of view there. Is the housing market in the midst of a housing bubble here?
Yeah, that's actually a great question, Ellen. Recently, there's been more discussion around home prices and the potential for another 2006-like housing bubble. And basically, there are two camps in the discussion. The first camp is the everything bubble, which believes that all risk assets are trapped in a speculative bubble, which is driven by the excess liquidity courtesy of the Fed's zero interest rate policy and quantitative easing. And then the second camp, which believes that home prices are not in a speculative bubble, but rather home prices are driven by fundamentals, right? And so we did address that question, or this question, in our 2021 Q3 housing market review, which we published last week on August 30th. And at this point, I don't really think that we're in the midst of a speculative bubble in the residential housing market. But I do think there is a potential, for the market to tip into a speculative bubble, kind of under the right circumstances.
Interesting. Can you talk to us a little bit about the framework you use to reach this conclusion?
Yeah, certainly. We kind of begin our analysis really by looking at the supply-demand balance in the residential housing market. And so on the supply side, we consider sort of new construction or housing starts. And then we also consider, the existing housing stock. And then on the demand side, we consider underwriting practices as, that's kind of the throttle, we think, for capital into the housing market. So weak underwriting suggests a potential for excess capital in the housing market. And then, stronger underwriting, which is, obviously more restrictive, right? Which suggests a restriction of capital into the housing market.
And what metric are you using to considering in your framework for home prices?
Yeah, so the metric that we're using on the supply side is we take into account the housing starts. And housing starts have really failed to return to pre-boom 2006 levels. In fact, Freddie Mac economists estimate a shortage of about 3.8 million housing units in the United States, most of which is attributable to anemic housing starts. Then, we also look at existing home sales, which actually has recovered to pre-boom 2006 levels and really is relatively healthy when you look at it, from that perspective. And then we look at months supply of inventory, and that provides a measure of the relationship between supply and demand in the residential housing market. So generally, when the month's supply of inventory is at or below 6 months, home prices tend to rise, and so it's generally referred to as a seller's market. And then when the month supply inventory is above 6 months, home prices are flat to declining, which indicates that you're pretty much in a buyer's market. And currently, the month supply of existing homes is around 2.5 months. So that's very, very low on a historical basis, and suggests that we're in a very, very strong seller's market right now. And then on the demand side, we take into account underwriting standards, which, as I mentioned earlier, in our view, is kind of the throttle to the amount of capital that flows into the housing market. And what we look at there is the Federal Reserve mortgage household debt service ratio. Kind of gives us an aggregate idea of the amount of leverage that's in the outstanding mortgage debt, if you will. And currently, the Federal Reserve's mortgage debt service ratio is at a historically low level, around 7.5%, and that's despite the recent expansion of mortgage credit, that we've seen through the pandemic. So that's kind of amazing, really, in my view. And then in addition, we consider, traditional underwriting metrics. So we look at these on a loan level basis. We look at the trends in the loan to value ratio, and then we look at the debt to income ratio, and then we look at the borrower's credit score. When you put these three things together, what we're really looking at is, borrower ability and borrower willingness to repay their loans, which are the fundamentals of really credit underwriting. And all of those three metrics, which I just outlined, have all declined during the pandemic. So that kind of suggests that underwriting standards have actually become a little bit stronger, and credit a little bit more restrictive as we moved into and through the pandemic.
So in this framework, to recap what you just said, we're seeing a persistent shortage of housing against a backdrop of increased demand and disciplined underwriting standards, which together have contributed to strong home price appreciation. Is that correct?
Yeah, that's right. I mean, you nailed it. That's exactly what we're seeing. So the recent home price appreciation that we've experienced, in my view, seems more or less justified right now, and is really driven by these fundamentals. And then we have the out migration from the cities that is really kind of putting pressure on residential housing or single family housing demand outside the cities and into the suburbs.
Yeah, absolutely. It seems like every other person that I talk to is eagerly trying to secure a home in the suburbs, whether they want to or not at this time. So with that, are there any other considerations that go into your view on the question of a housing bubble here?
Yeah, there is, because what we don't want to do is when we think about these things is ignore the potential for a housing bubble. So here we're kind of looking at, or what we discussed earlier, we're really looking at sort of supply and demand fundamentals, and we're looking at underwriting as kind of the throttle of capital that's going into the market. And we're not really considering the question as to whether or not there's a bubble. And the evaluation of single family residential real estate is really relatively difficult, right? Because you can have comparable sales and those types of things. But it's not like really, valuing a financial asset that may have, some known set of cash flows, which can be discounted at, a given interest rate. So it's a little bit trickier. So what we want to do is acknowledge that speculative bubbles do exist, and to do that, we consider the anatomy, of a speculative bubble, right? And that's in Manias, Panics, and Crashes. It's a book that outlines the more significant manias and panics and crashes in our economic history. So the first element of a speculative bubble is displacement, right? And so those typically start with a shock to the system. So in this case, the pandemic and the outmigration from the cities could be considered kind of that displacement in terms of, kind of the first part of a speculative bubble. And I'm sure a lot of people look at this and say, okay, well, we have that first piece of a speculative bubble. And then displacement is actually followed by a boom, in this case, a boom in home prices. And that creates a positive feedback loop. And one can really argue that we're in this boom phase, right? But the boom phase creates euphoria. And that's when current price appreciation is projected into the future. Now, I don't really think, as I talk to people, that most participants in the residential housing market are factoring in double-digit home price appreciation right now. But here we could substitute investors, right? So these are typically all cash buyers, and they're creating bidding wars, and those bidding wars are resulting in homes, being sold at prices that are significantly above the listing price. So we do have that when you look deeply there. And then the other thing is we have overestimation of work from home opportunities, on the part of people who are buying homes in the suburbs and fleeing the cities. So if it turns out that they really overestimated their work from home opportunities, that could also count as as kind of euphoria. So it's a little bit weak in this euphoria stage, but you can certainly put the pieces together that say, well, this is euphoria. And then the next is a negative shock, right, which follows, and that slows down the rate of appreciation. And leveraged, investors find themselves in a negative carry position. And so here's where really the disciplined underwriting that we talked about short circuits the risk of a speculative bubble. So we don't really have like these heavily over leveraged investors that are, 100 LTV, sort of buyers with, 50% debt to income ratios. So that's kind of the short circuit, I think, that you see here. And I think we're really what a lot of people that are in the non-bubble camp are hanging their hats on. And then finally, there's the bust, right? And that's panic selling, which results in greater price declines. So we don't really have the leverage, and we don't have the risk of leveraged buyers selling into a down market. But we do have investors, and to the extent that investors are driving prices over asking prices, that could factor in potentially into appraisals going forward. And there we could have the feedback loop that creates some euphoria. So I think there is some risk of a bubble, but I don't think we're in the midst of a speculative bubble just yet. We would need sort of a little bit more euphoria. I think we would need to see, underwriting standards begin to slip as originators, attempted to maintain volume, and that could feed back into the euphoria part. So I think we're right in the middle of that game. I don't think we're there, but it wouldn't take much, for us to tip into speculative bubble territory. Just a few things have to change.
Understood. And Glenn, I really enjoyed talking about this topic with you. Thanks again for joining us this month and sharing your thoughts on this.
Sure.
And for our listeners that may want to discuss the topic in more depth, please reach out to Glenn or your sales representative to schedule a call. And thank you for listening to the MUFG Global Markets Podcast. You can rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Please check back soon for more insights from the Global Markets Research team.